Let's talk about all that cash on the sidelines. And I think we have to kind of chop this up because Alex points out all these inflows we've been seeing into equities. That's not necessarily coming out of money market accounts, though, which still stand about $7 billion. And at 4.5%, I mean, if you are somewhat risk averse or you want more stability, why wouldn't you just ride that?
Yeah, it's a great question. And right now, cash is generating a lot of cash, right? If we have 7 trillion money market funds earning 4.5% interest every year, then that incremental interest probably needs to go somewhere. You're not just going to continue to build and build your cash stockpiles, especially as we see the S&P 500 hit, a 54-time all-time high yet again this year.
And of course, every equity strategist out there seems to think that if that money were to come out of money market funds, it would go into equities. But isn't there a case to be made that it might come out of money market funds, but might actually just end up in other fixed income assets?
Yeah, absolutely. I don't think it just goes into one thing. Investors want to be diversified. They see treasury yields right now and they look fairly attractive. They see credit yields right now, they look fairly attractive. If they're worried about bond yields rising, hey, maybe we go into leveraged loans or other floating rate products. So I think that rotation out of cash into a wide swath of other asset classes is a perfectly reasonable expectation.
What do you think is actually going to happen? I mean, do you think that the money is going to ignite those animal spirits, or do you think not? And that's actually a risk.
Well, so we have been kind of hammering on the power of cash on the sidelines really since 2022. We thought it would help avert a broad-based recession, and lo and behold, it did. Markets recovered pretty nicely, and we've continued to see that over the course of 23 and all the way through 2024. And a lot of that is predicated on the reality that we haven't seen this broad-based recession. People's fundamental expectations have gotten a lot calmer despite kind of all of the headline noise around geopolitical and the election and all of these different things. So as people start to maybe get a little bit more cautious on the outlook, perhaps some of the expectations for fiscal policy changes that are perceived as positive maybe get watered down a little bit, then that could start to put a little bit of a damper on the amount of cash that's rotating back into riskier asset classes.
So what do I do if I hold corporate credit right now? Do I just hold it and wait for that moment? Can I add at this point?
So what we're recommending in corporate credit is an up in quality strategy. Right now, you're not getting paid a lot to reach down in quality. In the investment grade market, triple Bs are trading pretty tight to single As. So perhaps it makes sense to rotate back into maybe longer duration single As where you're getting paid a little bit more yield for getting out the curve, but you have a little bit more credit protection there.
What's going to be sort of the main thing driving risk appetite in the corporate credit space? I mean, we talk about economic fundamentals that seem at least stable. And you have inflation, I guess. Is it under control? I don't know. Maybe it is. And you also have a relatively decent backdrop when it just comes to corporate earnings and cash flows and things like that.
Yeah, this is a really tricky one because everyone is expecting kind of a continuation of status quo into 2025. But we know we have a new administration. We have a lot going on in the world right now. We have a lot of headlines at the single name level as well. Expecting status quo is probably not a great base case expectation. And also at the same time, we have companies that have seen these very minimal spread volatility months for the past 12 months in 2024 and saying, hey, maybe we can pursue that acquisition. Maybe we could do some share buybacks and have them debt financed.
Well, that's what I'm curious about, particularly for some of the, I guess, weaker corporate names out there. You would think, at least if you assume some of the promises that this new administration has made, if those promises are kept, you would think that would create some openings for some of these companies, whether it is M&A or just refinancing, basically a little bit more flexibility than maybe what they would have had under a different administration.
Yeah, I think that there is definitely a perception that the antitrust environment is going to change pretty significantly. And it probably will, right? We're going to have a bunch of new people in charge who are probably going to be a bit more business friendly. But that doesn't necessarily change the fact that the cost of capital is elevated compared to where we were, that valuation multiples, it's, a little bit gappy between bid ask, what buyers can get and what sellers can get. And then also just the reality of trying to execute in a market that might see a little bit more volatility if the Fed doesn't necessarily do what everyone is expecting, or if inflation comes back. There's just a lot of unknowns, or if tariffs are kind of the new things making headlines like they were in 2018.
You're sounding pretty cautious, but without really sort of doubling down on that, because it's hard to stand in the way of some kind of rally. Am I reading you right?
We are cautious, but it's on a bit of a long-term view. We want to respect that power of the technical.
Right.
We realize there is cash on the sidelines. We would be foolish not to respect that. And we haven't seen enough kind of single name, real deceleration to get us really worried worried about the outlook for the economy in 2025. But what we can say is in a consolidation wave, you generally see that be detrimental to bondholders because you're using debt to juice equity returns. And in 2026, oftentimes those deals won't look quite as good as they did when they were first launched. And that makes us a little bit cautious on kind of the longer run view.
What's your biggest risk right now as you see it?
I think that the biggest risk right now is everyone is expecting a lot of the positives associated with the Trump agenda. Deregulation is positive, absolutely. Cutting taxes further is positive. And maybe looking past some of the potential for the noise associated with some other policies, combined with the fact that valuations are really stretched across a wide swath of asset classes.